Welcome to the G2 Financetech Weekly Market Update, where we bring you the latest highlights shaping the global markets and economy. This week, investor sentiment turned cautious as concerns around AI valuation, job cuts, and consumer confidence weighed on equities. Meanwhile, major central banks across the globe held rates steady, signaling a measured approach to future policy moves. United States. US stocks snapped a 3-week winning streak as tech-heavy indexes faced sharp declines. The Nasdaq Composite led losses with large-cap growth stocks under pressure amid renewed scrutiny of artificial intelligence spending. Adding to the uncertainty, the federal government shutdown stretched into record territory, denting investor sentiment and disrupting key data releases. On the economic front, October layoffs surged to their highest level in more than 2 decades, with over 1.1 million job cuts announced year to date. While the services sector returned to growth, manufacturing activity contracted for an eighth straight month, signaling continued softness in industrial output. Meanwhile, consumer sentiment fell to its lowest level since 2022, driven by concerns over personal finances and the ongoing shutdown. Inflation expectations edged slightly higher to 4.7%, adding to the cautious mood. In fixed income, treasuries posted modest gains, while high yield bonds underperformed as investors moved to safer assets amid the broader market pullback. Europe. Across Europe, markets ended lower, weighed down by profit taking in AI related sectors. The Stocks Europe 600 fell over 1%, with Germany, France, and Italy all posting declines. The Bank of England kept rates on hold at 4.0%, though Governor Andrew Bailey hinted that a December rate cut remains possible if inflation trends continue lower. Elsewhere, the European Central Bank and Nordic Central Bank also left rates unchanged. However, soft data persisted, with Eurozone retail sales contracting for a third straight month and Germany's industrial output showing only modest improvement, suggesting that Europe's economic recovery remains fragile. Japan. In Japan, equities retreated from record highs as investors booked profits from the recent AI-driven rally. The Nikkei 225 fell more than 4%, and the yen strengthened to the mid 153 range against the US dollar as safe haven demand rose. The Bank of Japan maintained its cautious stance on tightening, emphasizing the need for sustainable wage growth before raising rates. While nominal wages rose 1.9% year over year, real wages continued to decline, underscoring weak purchasing power. New Prime Minister Sanai Takaichi reaffirmed her commitment to supporting households and boosting the economy through fiscal spending, with a stimulus package expected later this month. China. Chinese markets edged higher, buoyed by improving US-China trade relations following the one-year truce agreement reached at the APEC summit. The CSI 300 gained nearly 1%, extending its rally to the highest level in almost 4 years. However, optimism was tempered by concerns over slower domestic growth as policymakers continue to seek ways to strengthen consumption and stabilize the property sector. Analysts noted that while the truce offers temporary relief, longer-term strategic competition between the US and China remains a defining theme for global markets. G2 takeaway. Markets took a breather this week as investors weighed mixed signals, from cooling growth and rising job cuts in the US to cautious central banks and renewed global trade diplomacy. At G2 Financetech, we believe volatility may remain elevated, but selective opportunities persist across defensive sectors and quality assets as monetary policy transitions toward a slower easing phase. That's all for this week's market wrap. Thank you for watching the G2 Financetech Weekly Market Update. Stay tuned for more insights next week. Do not forget to like, share, and subscribe for more timely updates on global markets. Thank you.